On March 9th, 2009, friends. That day, the S&P 500 closed at 676 points. Lehman Brothers had collapsed 6 months earlier. People's retirement accounts had been cut in half, and headlines were screaming, "The worst crisis since the Great Depression." Everyone was waiting, paralyzed. It was right in those days that an ordinary teacher named Margaret took the $50,000 she had saved for a down payment on a house and put it into a simple S&P 500 index fund. Her friends said, "You've lost your mind." Her family begged her. Margaret ignored them all, brothers and sisters. And do you know what? That $50,000 is worth $590,000 today. She didn't pick a single stock. She didn't time the market perfectly. She had no insider information. She simply saw that moment that comes once, maybe twice in a generation. That moment when fear creates opportunity and enriches ordinary people. Now let me tell you this, friends, because I'm here to share this knowledge with you. Right now we are in the middle of a very similar period. Not a market crash, but potentially something much more powerful. A convergence of forces seen once in nearly a century. And these forces will transfer wealth to ordinary people at a scale never seen in any event in American history. The number is $124 trillion. I almost don't want to write it because you won't believe your eyes, but yes, $124 trillion. This money will change hands over the next 20 years. And the vast majority of people have no idea this is happening, let alone how to position themselves. Today, I'm going to tell you exactly what's going on, show you why these conditions mirror previous wealth creation events that minted millions of new millionaires, and lay out in clear steps how ordinary people can capture their share of this historic transfer. What happened after 2009 perfectly illustrates how ordinary people build extraordinary wealth. The S&P 500 didn't just recover from that bottom, brothers and sisters. It launched directly into the longest bull market in American history. From March 2009 to January 2026, the market rose over 900%. The index recently crossed 7,000 points for the first time ever. $100 invested at that bottom is now worth approximately $1,000. But the biggest winners weren't Wall Street traders or hedge fund managers. They were teachers, nurses, accountants, and small business owners. They were teachers, nurses, accountants, and small business owners. And the data paints a truly remarkable picture. In 2010, the United States had approximately 8.4 million millionaire households. By the end of 2024, that number had nearly tripled, reaching 24 million. The country gained more than 15 million new millionaire households in 14 years. Think about that for a moment, friends. A group equivalent to the entire population of the New York metropolitan area became millionaires in less than 14 years. The vast majority of these new millionaires weren't entrepreneurs who sold companies or executives with stock options. They were ordinary people who participated in the market's rise through retirement accounts and index funds. According to UBS's Global Wealth Report published in 2025, America added 379,000 new millionaires in a single year in 2024. That means more than 1,000 new millionaires every single day. The vast majority didn't come into sudden wealth. They made steady accumulations in rising markets. UBS calls them everyday millionaires. This group, with a net worth between $1 and $5 million, has quadrupled since 2000 and has reached approximately 52 million people globally. The path to joining them is no secret. It's documented, repeatable, and right now becoming even more accessible. What makes the current moment even more significant than 2009 is something called the Great Wealth Transfer. According to Cerulli Associates' 2025 research, approximately $124 trillion in assets will change hands by 2048. This is the largest wealth transfer in human history. Nothing in recorded economic history comes close. Brothers and sisters, $124 trillion exceeds the total annual economic output of every country on Earth combined. It's more than 5 times the US national debt. Wealth accumulated over 8 decades is now about to flow across generations. The mechanics are simple, but the implications are profound. Baby boomers, the post-war generation born between 1946 and 1964, currently hold approximately 52% of all wealth in the United States, meaning roughly $78 trillion. The youngest boomers turn 62 this year, and the oldest are approaching 80. Over the next 20 years, this wealth will be transferred to children, grandchildren, and charities. Cerulli projects approximately $16 trillion flowing to heirs and $18 trillion to charitable organizations. Generation X will inherit approximately $39 trillion over the next 25 years. Millennials will receive approximately $46 trillion. Even Gen Z will begin receiving significant inheritances as the transfer accelerates through the 2030s and 2040s. The timing is critically important. Generation X will receive approximately $1.4 trillion per year over the next decade. This This coincides with a pivotal life stage where many are both caring for aging parents and supporting their own children. For this generation, the inheritance wave could transform retirement prospects that currently look uncertain. Millennials will wait longer but receive a larger eventual windfall. The $46 trillion heading their way will create multiplying effects as it combines with the career income of many entering their peak earning years. But friends, here is the critical detail that most coverage misses. The opportunity isn't just the inheritance. This massive $124 trillion money movement gains its real significance through the ripple effects it creates across the entire economy. When $124 trillion changes hands, that money doesn't sit still. It gets invested, spent, and deployed into businesses, real estate, and markets. Every dollar that moves creates opportunities for those positioned to capture a piece of that movement. The closest comparable event was after World War II. Returning soldiers used the GI Bill to buy homes, start businesses, and build the middle class that defined American prosperity for half a century. That wealth creation event produced the baby boomers who are now transferring their wealth. We are witnessing history repeat itself, but at a scale that dwarfs anything that came before. The parallels with 2009 run much deeper than most people realize. That year, three conditions aligned to open an extraordinary wealth door for those who recognized the moment. Stocks had hit rock bottom, a massive capital injection was coming, and most people were either too scared or too broke to take advantage of the opportunity. The current moment carries similar characteristics, though the mechanism is entirely different. Markets haven't crashed, but the wealth transfer will create both opportunities and dislocations. Some assets will be liquidated during the inheritance process. Others will be repositioned by heirs with different investment preferences. This movement creates buying opportunities for prepared investors throughout the transfer period. The capital injection this time isn't coming from the government. It's coming from the wealthiest generation in history. $124 trillion far exceeds any government stimulus program ever attempted. The entire pandemic relief effort totaled approximately $5 trillion. The wealth transfer is 25 times that. And just like 2009, most people have no idea what's happening. The great wealth transfer receives only a fraction of the attention given to daily market movements, even though its impact will be far more significant over the next 20 years. Those who became millionaires after 2009 weren't smarter than everyone else. They were simply positioned to capture the opportunity when it arrived. The same principle applies now. Understanding several key dynamics is required to capture this opportunity. First, relying on inheritance is the wrong strategy. According to Cerulli's estimates, approximately 62% of the wealth being transferred will come from high net worth and ultra high net worth households. These represent only about 2% of all households. The wealth transfer is highly concentrated. A small number of families will inherit massive amounts, while most families will receive more modest sums or nothing at all. Relying on inheritance alone is therefore a weak strategy. Most people won't receive life-changing inheritances, but they will be exposed to an economy supercharged by $124 trillion in moving capital. The opportunity isn't the inheritance itself. The real opportunity is what that money's movement does to asset prices, business opportunities, and economic conditions. Think about the ripple effects. As trillions flow into investment accounts, asset prices rise, benefiting everyone already invested. As heirs purchase homes, real estate values appreciate, benefiting existing homeowners. As inherited capital funds new businesses, job creation accelerates, benefiting workers across the economy. The wealth transfer creates rising tides across multiple asset classes simultaneously. Second, understanding where the money will flow is critically important. Research from Bank of America and Merrill Lynch shows that younger investors have dramatically different preferences than baby boomers. 72% of investors between ages 21 and 43 believe it's no longer possible to achieve above-average returns solely with traditional stocks and bonds. This represents a generational shift in investment philosophy that will redirect trillions of dollars. While boomers preferred blue-chip stocks and bonds, their heirs show much stronger interest in alternative investments, direct company investments, and new asset classes. Sectors aligned with younger investors' preferences will see massive capital inflows over the coming decades. Artificial intelligence infrastructure is already attracting enormous investment in 2026. Clean energy, healthcare innovation, and digital assets are all positioned to capture disproportionate shares of redirected wealth. This doesn't mean abandoning traditional investments. It means understanding that capital flows are shifting and positioning accordingly. Third, real estate positioning will be critical throughout the transfer period. The great wealth transfer will reshape housing markets dramatically depending on location. Demand will increase as wealthier heirs seek to purchase homes. Supply will increase as inherited properties enter the market. Suburban areas and retirement destinations where boomers concentrated may see inventory increases at moderate prices. In places places where younger generations want to live, competition may intensify as newly wealthy millennials pursue home ownership. The data already shows this divergence. Median home prices have risen over 150% since 2000, but that appreciation has been highly uneven. $500,000 invested in Austin versus Cleveland will produce dramatically different outcomes over the next 20 years. Geographic awareness translates directly to wealth accumulation. Fourth, staying invested throughout the transition period remains the most reliable strategy. Margaret didn't need sophisticated strategies for the $50,000 she invested at the 2009 bottom. She only needed two things: capital to deploy and the discipline to stay invested through subsequent volatility. The market has delivered an average annual return of approximately 10% over long periods. Someone who invested $500 per month in an S&P 500 index fund starting in 2009 would have accumulated over $250,000 by early 2026, not counting any employer match. But that journey included terrifying moments: the 2011 European debt crisis, the 2013 government shutdown, the 2018 trade war, the 2020 pandemic crash, the 2022 bear market. At every point, headlines said the rally was ending. At every point, those who stayed invested captured the subsequent recovery. The great wealth transfer will create opportunities, but the most reliable wealth-building approach remains consistent investment in broadly diversified assets over decades. The transfer simply adds tailwinds to an already proven strategy. Goldman Sachs research shows that missing just the 10 best days in the market since 2009 reduced annual returns from approximately 17% to approximately 12%. The best days most often occur during the most volatile periods when fear is highest. The same pattern will likely characterize the great wealth transfer. Recessions, corrections, and crises will punctuate the transfer period. Headlines will regularly suggest this time is different. History will prove those warnings premature, just as it did after 2009. Concrete numbers illustrate what consistent participation looks like over the transfer period. Consider a 35-year-old today who invests $500 monthly in diversified index funds for the next 25 years, roughly the duration of the great wealth transfer. At the historical average return of 10% annually, $150,000 in contributions becomes approximately $665,000. At a more conservative 7% return, it becomes approximately $475,000. Increase the monthly contribution to $1,000, which becomes achievable for many as careers progress, and the numbers scale accordingly. At 10%, $665,000 becomes $1.33 million. Ordinary people reach millionaire status through consistency alone. Fifth, the professions and businesses that benefit from wealth movement deserve attention. When $124 trillion changes hands, entire industries grow to facilitate the transfer. Financial planning, estate administration, tax advisory, wealth management, and legal services will all expand dramatically. Real estate transactions will accelerate. People who develop skills in these areas will find robust employment and business opportunities throughout the transfer period. The wealth movement doesn't just benefit heirs. It benefits everyone involved in managing, protecting, and deploying that wealth. The numbers already reflect this shift. The share of millennial and Gen Z clients at high net worth focused financial firms grew from just 8% in 2021 to 25% by 2024. Sixth, the spousal transfer dynamic that precedes intergenerational transfers creates its own opportunities. Cerulli estimates that approximately $54 trillion will first pass to surviving spouses before eventually transferring to the next generation. Nearly $40 trillion of these spousal transfers will go to widowed women. This creates a massive and growing market for financial services targeting women. Historical context helps put this moment in proper perspective. America has experienced a handful of wealth creation events that transformed ordinary people into millionaires on a massive scale. The post-industrial revolution era, the post-World War II boom, the bull market from the 1980s to 2000, and the recovery from 2009 to 2026. Each created millionaires from people who simply participated in economic expansion. No genius required, no insider access needed. Just being present and being patient was enough. The great wealth transfer represents the next chapter. $124 trillion will move over 25 years. Economic activity will accelerate, asset prices will be supported, opportunities will emerge. The question isn't whether the transfer will happen. It's already happening. The question is whether you'll be positioned to benefit. Margaret didn't know in 2009 that she was capturing a once-in-a-generation opportunity. She simply saw that fear had created value and acted on it. Today's opportunity is different in mechanism, but similar in scale. Trillions of dollars are moving. Millions of new millionaires will be created. History will record this period as a defining moment of wealth creation. Now you know this, friends. You know the scale. You know the timeline. You know the strategies that will help ordinary people benefit. benefit. How you use this knowledge will determine whether you'll be among the millions of people who will remember this period as the moment everything changed. The ball is in your court, brothers and sisters.